Welcome to the Research at City podcast. I'm your host, Lucy Baldwin, Head of Research at City. Today, I'm delighted to be joined by Max Layton, who's our Global Head of Commodities Research here at City. Hi, Max, and welcome to the show.
Thanks, Lucy. Yep, good to be here.
So, Max, it feels like a great time to be sat here discussing commodities. It's been a remarkable year for some of the commodities over the course of 2025, and I know there'll be a lot of people fascinated by your outlook for 2026. So maybe we can start with gold, which has been attracting an awful lot of headlines this year. I think it's up more than 50% now this year, more like 60% probably. It's rallied more than $1,500 an ounce to well above $4,100 now. Where do you really see it heading next as we go into next year, Max? Should people continue to be long gold?
Yeah, so I take a deep breath there to start, Lucy, because the gold bull market has been driven by a number of factors, and we have quite a controversial call out there over the next 12 months. We've been bullish for the last couple of years. We've ridden the vast bulk of this bull market, and it's been a pretty exciting time to be an analyst. The next 12 months, we actually don't see gold moving higher. And the core of that reason, or the core driver of that, is that we think US growth sentiment will turn higher. So one of the three primary drivers of this gold bull market has been the cyclical slowdown, the concern about US growth, the potential for the labor market to continue to weaken, and for there, even in the worst case, to be a recession. And people have been hedging that risk, the equity downside related risk, by buying gold for the last couple of years. That accelerated this past 12 months with the concerns around tariffs and the impact that they would have, both upward inflationary pressure and downward growth pressure. And we think those concerns are going to turn around. Basically, we think President Trump's already pivoted towards trade deals, towards peace deals, and toward tax deals. And this is what Secretary Bessent's been talking about over the last couple of weeks. These factors are going to combine, we think, in the base case in 2026 to reduce the concern about US growth, to kind of take some of the heat out of this gold bull market over the next 12 months.
That's interesting, Max. And you mentioned three areas that were driving this gold bull market, obviously one being that cyclical dynamic. Talk us through the other two as you see them.
Yeah, the other two aren't going away anytime soon, unfortunately, we don't think. The other two, sovereign debt concerns, so fiscal concerns, particularly in the US, large deficit, a very high proportion of that being interest costs. And these concerns are certainly part of the bull market over the last 12, 24 months. It's hard to say exactly how much of the investment buying that we've seen is actually due to that, because those concerns have been elevated at the same time as US growth has been slowing down, labor market's been slowing down, tariffs have biggest in 100-year tariffs have happened. But yes, certainly the sovereign debt concerns are a core thematic for this gold bull market. And the other big one is geopolitical concerns. So since Russia-Ukraine war in 2022 began, we have seen allocation to gold as a hedge against that kind of divergence between the US, Russia, and to some degree China.
Yeah, fascinating. So you've got a couple of maybe more structural factors and then obviously the important cyclical ones. And of course, it's quite an unusual backdrop to have seen risk assets do so well. I mean, you only have to look at US equities or the performance of mega cap tech this year. Again, another strong year for the S&P 500. It's really interesting to see that alongside such a strong gold bull market. I guess that's probably not happened that many times in your career.
Actually, gold tends to have some kind of positive beta over the last 20 to 30 years to global growth. There is some gold purchased out of income, which is on the jewelry side, on the demand side of the equation. But yes, it's quite rare that you have the degree of this bull market and the strength in the equity market.
And Max, to want to be long gold here going into next year and to see upside, I guess, over the course of the next 3 to 6 months, what do you have to believe, do you think, in terms of the cyclical picture? Do you have to believe that you get a US recession? What are the sort of, if you like, the consensus views out there expecting to see to support the upside from gold? And I guess the other obvious topic is to think about some of the other drivers, whether that's central bank buying, whether that's the ETF related demands and things like that. How do you see that playing out?
Sure, yeah. So our baseline view, although it's relatively low conviction, we've only put a 50% indicative probability on it. That baseline view of a neutral to bearish 12-month outlook is super out of consensus, I would say. It's consensus that gold is going materially higher. We put a 30% indicative probability on our bull case scenario, which is that gold reaches $5,000 by the end of 2026 and $6,000 by the end of 2027. And look, it's entirely plausible that that happens. One of the really interesting features of the gold market is actually quite a small market relative to the potential capital inflows. So how you can get there is essentially people continue to want to allocate to gold for those structural reasons, or because we get the cyclical call wrong. And basically the US doesn't turn higher through the middle of next year into the second half of next year. And in those scenarios, you can continue to see the ongoing off the charts inflows into gold continue, and that will drive gold higher. That $5,000 and $6,000 call it's quite mechanical actually, so we're kind of pretty proud of the framework we have to kind of outline that bull scenario, also our base case scenario, and that is around the fact that the gold market, as I mentioned, is quite small. So just to put a number on it, global household wealth is about $600 trillion. If 0.1% of that household wealth wanted to shift into gold tomorrow, you would have to double mine supply overnight. If you wanted to take the allocation, currently allocation of households about 3.5%, if you want to take that up to 5%, a lot of people think 5% is roughly the right allocation to gold for households to have. If you wanted to take to 5%, you'd need around 20 years of mine supply to do it. So it's not possible for the gold market to handle the kind of wealth shifts that people might want to do if they maintain their kind of fear about geopolitical issues, about the trade wars, about US growth, and all of the various concerns that are driving gold. So it's too small a market, and it could easily go significantly higher.
And central bank buying has obviously been huge, and I think a lot of people really felt that there was a sort of turning point again around Russia, Ukraine, the sort of views that there was some element of weaponization of the dollar. Talk to us about where you think that demand could be over the course of the next few years.
Yeah, so central bank demand is certainly large by historical standards, but it's been roughly unchanged at about $100 to $150 billion per annum over the last 3 years, and it's been mostly driven, in our opinion, by China. That central bank demand, we think, will remain at similar kind of levels over the next couple of years. It's an interesting component of this bull market, and it's what a lot of people focus on. But the data of both reported and unreported buying do not suggest that it's been the driver of this bull market over the last 12 months. The last 12 months has been investment-driven, non-central bank demand-driven. Now, many investors are buying because they believe central banks are buying, so there's that. But at the end of the day, the bulk of this investment demand has been correlated with the tariffs and the slowdown in US growth and the concern about US monetary policy independence.
And that's a good question as well, because as we go into next year, there's many people out there that think the US Federal Reserve debate around independence will open back up again as we find out who the new chairman of the Fed will be, and ultimately the makeup of that Fed over the course of the next 6 months or so. There's obviously a lot of people that think they may be more dovishly leaning than they have been. Do you think that's likely to renew fears around fiscal woes and then bring that debasement debate topic back to the fore, with gold potentially then being the beneficiary?
Look, it certainly could. There's definitely the possibility that that happens. One of the channels through which that happens would be Lisa Cook being replaced and the balance of power on the Fed board shifting towards a more pro-dovish, perhaps less independent situation. And we're basically going to find that out by Feb 20. So there's a key date. There's a February 20 board meeting of the Fed, and they will, at that meeting, confirm or not up to 12 different nominations for the next 5 years, I think. It's the baseline view that the Fed remains independent. So even though you get highly likely a very dovish Fed chair and maybe one or two other significantly pro-President Trump members, that the bulk of the voting committee, the bulk of the FOMC voting committee remains unquestionably independent, essentially. So I think it's going to take some of the heat out of the gold market.
Yeah, interesting. So that's a key date to watch for. And then finally, just to wrap things up on gold itself, but how do you see ETF demand and the impact that that has on the gold market?
Yeah, I think it's had a huge impact on the gold market. So gold market We're only producing about 3,600 to 3,800 tonnes of gold per year, and the ETFs came in this year and have bought well over 600 tonnes, almost $70 billion worth of gold. It's difficult to tell exactly how much of it's institutional versus retail, but it's both. It's both. You've had a lot of demand for gold through that channel, biggest demand since 2020, and before that since the period of the build out of the ETFs, 2008, 9, 10, 11. So, they've mopped up a good fifth of all supply, central banks another 1,000 tonnes, and retail bar and coin and ultra high net worth the rest. And there's basically nothing left for jewellery. So you're trying to price out jewellery. But it's difficult to price out jewellery when India and Chinese GDP growth is good, the currencies are okay, and they want to keep buying jewellery. So everything's going right for gold at the minute.
Yeah, it's been the perfect storm. And I guess for some investors, Max, rather than playing this via gold directly, the gold miners have been an area of focus. I mean, I can imagine that their margins must be through the roof and sort of towards peak levels. Put that in some kind of historical context for us.
Sure, yeah. So at these prices, 4,250, you can compare them to the miners' marginal costs. So the high-cost miners, they're producing this stuff, this gold, they're producing it out of the ground. The cost of production is about $2,000 an ounce. So the higher-cost miners are making $2,250. The average miners are making over $3,000 an ounce. If you put that in historical context, these 100% margins for the high-cost miners is the highest in well over 50 years. I mean, we've only got 50 years of data, and it's the highest in that entire period. That in a way to me that's shockingly high because you're comparing it to the 1970s, early 1980s. Certainly you're comparing it to the second oil shock period where the gold price went up dramatically from low single digits to off the charts. You had to rescale it. Even in log scales, you had to rescale it. And the miners are making as much, if not more money today than they were back then.
Yeah, that's really interesting. I guess the positive with the stocks, with the equities, is at least you've got some kind of valuation metrics to look at to compare them versus their history. Whereas I think gold's quite hard for a lot of people to get their head around, like whether it is or isn't too expensive at certain levels. And you've spoken a little bit, Max, about obviously the sort of hedging characteristics that gold can have in portfolios and this sort of shift to higher asset allocation for, I guess, many pension funds, sovereign wealth funds, and even households, right, in terms of putting money into gold. But how do you think about valuation? What are the metrics and the techniques that you in the industry use and look at?
Sure. I think this is one of the fun parts of my job is to ask the question, how high can it go? What's the right price? And one way you can do that is looking at all the different valuation metrics. One of the valuation metrics that we looked at was, let's just take the amount of gold that's being bought and sold in the flow market, times it by the gold price, and see how much the world's allocating to gold, and then compare that to history. And what we found is we're spending as a planet, we're spending on this gold that we're pulling out of the ground and the jewelry scrap and the bar and coin sales. We're spending basically almost double what we spent even in 1980 in the second oil shock. So we're spending about 0.5% of global GDP, a bit over 0.5%, about 0.6% of global GDP at the moment. And we're spending about 2.2% of all gross national savings, which, normally we'd be spending, 0.1, 0.2, 0.3%, and now it's 0.6. This is massive, $600 to $800 billion, massive amounts of money we're allocating to gold out of our savings or income. And the other way you can do it is look at it as a share of your wealth. So we can look at the stock of gold that we've been building for thousands and thousands of years, times it by the gold price. And it turns out that was worth about $30 trillion, which if you just take the household ownership of that as a share of the global wealth, it's about 3.5%, which I mentioned earlier. Normally it's about 1.5. So on these kind of long-term metrics, or even whether you look at it versus broad money supply, it looks extremely high. Doesn't mean it can't keep going up. It certainly could keep going up, but there are significant valuation concerns about this market.
Yeah, it's fascinating. So whichever sort of valuation method you use, essentially, whether it's stock, whether it's flow, whether it's anything that you've historically compared it to really as an asset class, it looks expensive. I think there'll be a lot of people, Max, listening thinking, gosh, that sounds a lot like US equities too, with the S&P trading at the sort of 98th percentile of its history. So I guess that begs the question a little bit around how you think it's going to trade in an equity market downturn, right? If we for any reason saw a pullback in equity markets or a correction there, do you think, given what gold has done more recently and how it's traded more recently versus equities, do you think it's still going to prove to be a good hedge against that?
Yeah, very recently it's actually traded pro-risk. But if you look at how it trades in the dot-com period, in the financial crisis, during COVID, or even during Liberation Day this year, gold went down. It had a positive beta to the sell-off in equity. So in terms of being a good near-term hedge to an equity sell-off, it's not going to be that. This is part of the valuation concern I have with it, which is to say that if there was a big equity correction, gold would almost certainly go down with that. And then you can buy gold. That might be a good buying opportunity, certainly, because obviously if it's a big enough equity correction, you can expect a policy response, and then you might want to buy gold. But yes, it's not a great hedge against equity downturn, in our opinion.
No, it's great, Max. It's very clear. So it doesn't represent at these levels a great hedge in your mind against a correction in markets. You don't buy it speculatively because you think it's going to go up. Essentially, you feel the debasement trade has largely played out for where we are right now. So on that basis, if it's not gold that you want to be long within the commodity space, and I guess maybe more specifically in the metal space, what are the other commodities that you would look at across that arena, Max? Particularly given, as you say, you're expecting to see essentially lower rates, but also continuation of sort of trade deal resolutions, therefore maybe better US growth next year as the fiscal stimulus comes through. Maybe we start to get through the first half and see the growth picture for the US then really turning a corner. If that pans out, what are the areas that you would be telling investors to take a look at?
Yeah, so we think the answer to that question is certainly copper and aluminium. So we think this precious metals bull market is going to broaden into copper and aluminium. Copper's already doing well. It's up almost 30% this year. Aluminium well over 10%. We think they're going to really pick up the baton from the precious metals and drive higher over the next 12 months. They have both a strong exposure to those macro factors that you mentioned, but they also have very bullish supply-demand dynamics and some very bullish structural narratives. So copper's challenged on the supply side. Aluminium's very power intensive. Obviously, there's some concerns about lack of power globally. Just to throw a number out there, your kind of average Ali smelter is paying $30, $40 a megawatt hour. And for the data centers, they're willing to pay at the margin lately $110, $120 a megawatt hour. And this aluminium is essentially power in the form of metal. So you can, if you do like a shadow pricing at what the data centers are willing to pay, you're talking about the cost of production rising dramatically of aluminium over the next 3 to 5 years. Anyway, there's a lot of bullish narratives on both copper and aluminium related to humanoid robots, power sector, AI, data centers. And then on the supply side, they're both pretty challenged. So yeah, we like them both over the next 6-12 months, but also over the next 3 to 5 years.
Yeah, that's fascinating. And how bullish do you have to be on China's economic growth prospects to want to be long those two names?
It would help. But you don't have to be bullish. They've done very well, actually, over the last few years, despite China being very soft. So most of metals, base metals, industrial demand comes from historically what we consider cyclical sectors, very exposed to China. But actually in the last 3 years, since interest rates have been very high, almost all their demand growth has come from future-facing sectors like energy transition, now more recently data centers, power grid build-out. So basically their demand growth has shifted to sectors that we think are more structural, that are going to continue over the next few years. And I would say a China pickup would be a bonus. You don't need it to be bullish, but it would potentially make those rallies explosive.
Got it. No, that's very clear. And Max, you talked a little bit about power. Let's talk about the energy markets. What's going on there? I know historically the team was fairly bearish oil, but I would say arguably now you're still at the more bullish end of the broader spectrum when I look at consensus expectations now for oil, at least as in relative to that set of other commentators. Talk us through, I guess, where the consensus picture is for oil. Is there risk down towards 50 if you have essentially resolution with Russia, Ukraine, and maybe some other conflicts around the world? What does it look like at 60? What has to happen? What do you have to believe for oil to be back at 70 plus? Give us a bit of a sense, Max. And obviously there's a lot of people that will be interested in the baby drill narrative and the impact that the United States is having on that market?
Yep. Well, there's a lot to unpack there. Thanks for the question. Oil's gone down around $20. It's been a really choppy grind lower over the last couple of years. We're modelling a surplus market at the moment, and we think that will continue. But we don't see much downside in the price. Brent is trading around $63, and our average forecast for the bulk of next year is not much below that. At that $60 level, we think is going to be the pin for the next 6 to 12 months in the baseline scenario, certainly. And the reason is, well, there's quite a few reasons, but when you go sub 60, we think OPEC Plus will respond, and or you will have US SPR builds, and or if the war is continuing to go on, there will be room for sanctions to ramp up. So essentially, I don't think there's much political will either from the US or from the OPEC countries to have oil for any sustained period below 60. If you have a big rally in oil price for whatever reason, whether there's just unexpected or even expected but not yet materialized disruptions to supply, whether it's Russian supply or Venezuelan supply or any other unexpected supply, if you rally much above 60, while OPEC is there ready to take market share. So I think we're pinned around 60. In terms of potential for it to kind of overshoot for a longer period, it really is all about Russia-Ukraine war. You know, if it ends earlier, then you'll free up a lot of barrels that are on the water. Then you will also probably see China stop buying as much because they'd have to pay close to market price. Currently, they get heavily discounted Russian barrels. So they'd have to pay markets, and maybe they stockpile less, which means you see more inventory show up in the Western kind of markets. So yes, overshoot, but even then it's temporary. All those factors I mentioned that could take you back to $60 if you went sub 60 in a Russia-Ukraine war scenario, they can all happen. So yeah, 60 is roughly the right number.
And Max, is that fair to say at that level you're a little bit more bullish than the consensus that's out there?
Yes, and that's been true for about 6 months. So I think we've been more bearish than consensus for a couple of years, but over the last 3 to 6 months or so, I think the consensus has moved well below us, and now we're sticking with that.
That's fascinating. Yeah, it's a sort of a shifting demand-supply picture, clearly, in the oil markets.
Yes. I've just mentioned on the oil market, there's some really interesting developments in the product market that have potential impact on US monetary policy, on the US economy. We think they could be influencing what's going on with President Trump's action towards ending the war. So crude oil prices are down 15 to 20% this year. But the product prices, so you pay a premium over and above the crude oil price for turning it into gasoline and diesel, those premiums have gone up a lot, primarily, but not only because of Russia-Ukraine war. So actually, things like the diesel price in the US, the wholesale price is not down, it's flat. So people think oil is down, but it's not down. And that means there's no big deflationary impulse on the US economy. If anything, at the retail level, diesel and gasoline prices are up at the pump in the US. They're factually up at the pump. And, this is maybe potentially one of the reasons why President Trump is pushing for a quick end to the war, because you might not get crude oil to go much lower if the war ends, but you would get that product premium. That product premium, which has gone up dramatically, in some cases tripled, that would come way back down to earth, and you'd have a big deflationary impulse from that, provide some room for the Fed to cut, things like that.
Yeah, it's definitely playing into the politics in America, isn't it? We've seen that with recent elections, and as you say, that disconnect between products and the headline oil price is quite notable and clearly impacting the cost of living. So Max, thank you. We could keep you here all day, but I think we probably have to close out because we are out of time. So thanks for joining us.
Thanks, Lucy.
This episode of Research at City was recorded on Monday, December the 1st, 2025. I'm your host, Lucy Baldwin. Please do join us next time as we discuss holiday travel with our aerospace and defence analyst, John Godin.
This podcast contains thematic content and is not intended to be investment research, nor does it constitute financial, economic, legal, tax, or accounting advice. This podcast is provided for information purposes only and does not constitute an offer or solicitation to purchase or sell any financial instruments. The contents of this podcast are not based on your individual circumstances and should not be relied upon as an assessment of suitability for you of a particular product, security, or transaction. The information in this podcast is based on generally available information, and although obtained from sources believed by Citi to be reliable, its accuracy and completeness are not guaranteed. Past performance is not a guarantee or indication of future results. This podcast may not be copied or distributed, in whole or in part, without the express written consent of Citi. Copyrights 2025 Citigroup Global Markets, Inc. Member SIPC. All rights reserved. Citi and Citi and Arc Design are trademarks and service marks of Citigroup Inc. or its affiliates and are used and registered throughout the world.